U.S. regulators have seized a bank the largest to fail since the Great Recession. It's Silicon Valley Bank, which has branches in Boston and Newton. Concerns surfaced this week about the bank's financial stability and announced it had to sell shares in some of its portfolio.
Silicon Valley Bank is the 16th largest bank in America, and in 72 hours it went from being a trusted and respected darling of Silicon Valley to total collapse. This is how the Fed might have finally broken something. SVB has had a long history of lending money to companies and entities in Silicon Valley. We're talking about venture capitalists and startup companies. By the end of the helicopter money era of 2021, where everything was going up, the bank had $190 billion in deposits, and they did what banks usually do and invested that money so that it could find a yield. Of the $190 billion they had in the books, they took $80 billion and put it into mortgage-backed securities, or MBS. As you might know, MBS are basically a bunch of mortgages bundled up into a package so they can be traded and sold en masse. This is a pretty typical investment for a conservative bank to make, and to be fair, they were not doing anything crazy at all by buying MBS. How much money were the MBS making them? Only 1.5%, so not much at all. But remember, they were buying these MBS back in the days of zero interest rates, where there wasn't the option of buying something like U.S. Treasuries, which were yielding 0% back then. So the bank did the sensible thing and bought these MBS tranches, which are considered a pretty safe investment. Well, there's a thing that happens with these MBS tranches when the Fed raises interest rates. These mortgages back then were yielding low amounts because the interest rates on the mortgages were so low. Well, that's no longer the case. The mortgage rates these days are well over 5%. And now, when an MBS is packaged and sold on the markets, the yield is much higher. So what's the problem? Well, the problem is that if you bought an MBS a couple of years ago and want to sell it on the open market for any reason, you're going to get much less money for it now. Why? Because the newer MBS yield a lot more money. That's why. Who wants your stinking 1.5% yielding MBS when the new ones are yielding 5%? So what happens? The price falls. And what happens if you're a bank like SVB that bought $80 billion worth of MBS 2 years ago? That's right. Your MBS is worth way less now. In other words, you are deep underwater. Now imagine that you're a VC or startup company and you have cash at the Silicon Valley Bank. Why wouldn't you just take that money and buy U.S. Treasuries yourself? These treasuries are currently yielding as much as 5% if you buy a 2-year treasury. That's a solid ROI, so why not just park your money in a place that's theoretically the safest investment in the world, U.S. bonds, and wait for the market to recover? That's what a lot of VCs and people banking with Silicon Valley Bank did. As people went in and took their deposits, putting them into treasuries instead, Silicon Valley Bank was forced to sell a bunch of its MBS tranches to shore up their balances. Money was leaving the bank, and the bank, needing to get money back into its coffers, did so by selling the MBS tranches they had at a loss. How much of a loss? Well, recently they sold a bunch of MBS tranches for a loss of $1.8 billion. This alone didn't cause the crisis with Silicon Valley Bank. 2 other things probably also caused problems. Firstly, another bank you likely heard of, Silvergate, which was connected deeply with the crypto market, also went under just last week. So the market had that top of mind. Then Silicon Valley Bank announced a few days ago that they needed to raise capital to the tune of $2 billion to further shore up their balances, indicating that the bank was facing a liquidity crunch. If you put the Silvergate news and then Silicon Valley Bank's announcement back to back, it caused many people who banked with SVB to go into panic mode, and they started withdrawing money. This itself led to a positive feedback loop with everyone rushing to the bank to withdraw their money, and we're now in the situation we're at where the market believes the bank is insolvent and no one wants to do business with them. Here's where the bigger problem lies. SVB isn't the only bank that's deeply underwater. Most banks are, because most banks like SVB bought MBS and other securities like stocks as investments. And what has happened to the prices of these assets over the last few weeks? They've gone down a lot, again because of super fast interest rate hikes. The Fed might finally have cracked and broken something if more banks going forward face some kind of bank run. Hopefully the situation doesn't get worse, but if we see a series of bank runs in other banks the size of SVB, then the Fed might finally have gone too far and will have finally been said to have broken something in the financial industry. Let's also remind ourselves that when Silvergate collapsed recently, there was a ton of finger pointing at the crypto industry. This is what happens, they said, when you bank with crypto. Of course, I'm sure no one will have anything negative to say about banking with Silicon Valley companies because of the SVB collapse, but it just goes to show that the critics of crypto have never been very consistent.